Guys, a lot of stuff happening today and this week in the markets, in the economy, and in stocks. A lot of companies reporting. Stocks may go up, stocks may go down. In this video, I'm going to show you how I'm going to navigate the market this week. Guys, 23% of the S&P reports this week. Not only that though, these companies attribute 24% of the total market cap of the S&P are just in these. So even though 23% of the S&P is reporting, just these 5 companies alone make up 24% of the market cap in the S&P. So there's a lot coming out this week. And let's not forget the Fed rate decision. A lot of excitement happened in the last year, in the last few months about what the Fed's going to do. A lot of people banking a lot of Fed cuts this year. Again, we've talked about this in many videos. If the Fed is cutting rates, what does that mean about the economy? The market's expecting 0 rate change, which is expected for this month, right, Mo? But
yeah, absolutely.
But what's the big difference? The big thing is they're going to be looking at what's the Fed saying? What are they saying during these meetings? Are they concerned about anything? You saw that core inflation came down significantly last week. Significantly. Their goal is to get to 2%. But based on the most recent data, the core inflation actually in the last year is below 3%. It was at 2.9%. Remember, the Fed's goal is 2%. So they might be working well on their way to where they need to be, where then they can start sitting there and saying, at least hold still. Mo, what were you just telling me about the National Association of Realtors?
So I met with a realtor yesterday. The National Association of Realtors has priced in 3 Fed rate cuts this year. Don't know when they're going to be, but it's 3 throughout the year. I think that she said that they planned on it starting in the middle of the summer.
Isn't that interesting? Because you would think that the realtors would have a strong bias towards promoting rate cuts. However, that the number of cuts of only being 3, that's actually much less than a lot of people. At one point, people were factoring in 7 rate cuts this year. And when I heard that, I was like, wow, that's a lot. Guys, I mean, listen, anything can happen. The one thing we know about economies is you never know what's going to happen. But 7 seemed aggressive. For me, to hear 7 rate cuts, that said the economy had to be having some sort of issues. Because remember, the Fed cuts rates to boost economic growth, not to inhibit economic growth. So when you're cutting rates, the reason why they wanted to inhibit economic growth before was inflation was rearing its ugly head. So how do you slow that down? You raise rates. So even though inflation's coming down now, it doesn't mean you sit there and start cutting rates to get inflation back up again.
And if you look at the CME Group website, there are 8 meetings this year. So you can see the span up here. And this meeting, it's basically a 97% chance that they're not going to change the rate. So that if it's the 7 rate cuts that you're saying that people are expecting, that means that the next 7 are going to be cuts. Doesn't seem very probable.
And do you have the probabilities on the other ones, what people are factoring in for the other decisions? Oh, wow. Look at that
in March, basically 50-50.
On what, a rate cut versus keeping it the same?
Mm-hmm. And then you're going to see you have the highest chance of a rate cut coming in at the May meeting. It's about 50%. Let's see. Let's continue on. About 11% of people say that it's going to stay the same at that point.
Oh, wow. June, so people are really banking on a rate cut.
Right. Now you look at June, you're actually getting into the 4% range.
Wowza.
Let's go July. Let's see where we're at. This is interesting. July goes lower. September stays the same. November goes lower. And by the end of the year, if you base it off these percentages, we're already in the 3% range of rates. So that's significant cuts this year if these are correct.
So that's all great and dandy with rate cuts. Now, guys, with earnings, remember, if you're new to the channel, we always say this. We don't really focus on quarterly earnings at all. We talk about them because they're active in the news. We use them as an opportunity to buy great companies at great prices if the companies miss on some sort of earnings. But you got to remember, anything can happen. We've seen companies miss on EPS and revenue, but guide properly, the stock skyrockets. We've seen companies crush it on earnings per share and revenue, and the stock tanks because their guidance is bad. This is why we advise people, don't worry about quarter-to-quarter earnings. Go look at any one of these companies over the last 10 to 15 years. They've missed, they've beaten, they've crushed. What matters is, what is the long-term trend? Are you buying a company at a good price? That is what matters here. Now, this is a value-based channel. Our goal is to look at long-term value. Even though things might feel like they're crushing it right now, we still think it's a little euphoric. But remember, it's okay. Every single time there have been major pullbacks in the market, it leads to higher highs at some point. It might take time, but again, that's okay. That's why we teach dollar cost averaging to low cost ETFs like VOO and SPY. Now, the biggest metric I look at when looking at stock market value is a very consistent stock market to GDP ratio. What this does, guys, it takes the stock market's market cap, divides it by total GDP. And the reason being is, in any country, as GDP goes up and up, the companies within that country should also go up along with it. And there's going to be some sort of ratio. Warren Buffett calls this the single most reliable metric at any given time on where valuations are. Now, again, a lot of people out there will say, oh, that doesn't matter because money is made overseas, blah, blah, blah. Fine, I'll get that in my second metric, which is the 10-year cyclically adjusted PE ratio. It's a very complicated name, but it's very simple. It takes the last 10 years of profit on the S&P, no matter where the profit was earned, locally, in another country, does not matter. The 10 years of profit brings it all the way to today and divides the market cap into this to give you some sort of 10-year PE ratio for the market, okay? So where do we stand today? Now, for those of you in our community, you're very used to this sheet. I report it several times a week. Guys, the most recent GDP number came in at $27.940 trillion for December 31st. Based on the S&P index, which is a market cap index, we are currently, based on history going back to 1929, 86.8% overvalued. The historical 10-year average for returns, not including dividends, is 6.9. But obviously, the more you spend on it, the higher the overvaluation, the lower your returns. I'm not trying to put fear in anybody's mind. What I'm trying to say is just get ready for volatility. The younger you are, the better. As long as you have 10 or 15 years, you can dollar cost average into this and make a ton of money. The opportunities for you when markets fall are insanely awesome. And I want you to remember this as we go forward. I don't want you to buy into the fact that people say, oh, we want stock prices to go up. No, you want stock prices to go down, especially the longer your investing horizon is. You want to put as much money in as possible when stocks are low. So going back to 1929, the states were 86.8% overvalued based on the stock market to GDP ratio. Now, going to the 10-year cyclically adjusted PE ratio, it's currently at 32.92, and the historical average is 17. So we're 92.8% overvalued. That is a big, big overvaluation. It's actually worse than the stock market to GDP ratio. So for those of you out there who are going to sit there and say, oh, the stock market GDP doesn't matter, fine. But this is more overvalued. It shows fair value at 25.36. Now, I also don't want you thinking, well, if it's so overvalued, I should sell. No, your job is not to time the market. Your job is to invest in low-cost ETFs. And if you choose to take a portion of your money to invest in individual stocks, guess what? Mo, I own 16 stocks right now. How many do you own?
Probably about 10.
10 stocks. We're still finding value. Now, do we think that when we buy a stock, it's going to go up from there? Absolutely not. It's going to go lower. And we're going to use that as an opportunity to buy more shares of a good company at a great price. Remember, Warren Buffett always says, it's better to buy a great company at a fair price than a fair company at a great price. The question is, what makes a great price? To me, higher returns doesn't necessarily always make a great price. If I could buy Apple, for example, at an expected return of 12%, that far beats some small company that I could buy at an expected return of 14 or 15%. Because Apple's a behemoth. You look at a company like Microsoft and Google and Amazon with all these diverse cash flows. If you can buy them at good prices, that to me is a great price. Because you're buying a stable company with a lot of diverse revenue, a great balance sheet that you can sit there and keep dollar cost averaging into that as well. So these numbers shouldn't scare you. These numbers should get you excited that the future holds a lot of opportunity if market fall. If the markets fall, especially if you're young. A lot of our viewers are under the age of 40 or 45. You got so much time. You should hope for lower prices. Don't fall into the whole trap of wanting stocks to go up. You want to put more money in at lower prices. This is a big thing we're trying to teach on this channel. There's a lot of excitement out there for AI. That's the big hype right now. If you look back at our videos in the past, when EV was the big hype, what did we say? Guys, be careful. The hypes will fade. Hypes always come in and out. The question is buying great companies at great prices, buying stable businesses that aren't about the hype. I want you to program yourself into a way of thinking of, oh my gosh, everybody's chasing this. I should not be in that because there's probably a disconnect between price and value. That's the big thing we're trying to get to here. We want to reprogram ourselves to sit there and look forward to lower prices. In our community, it is amazing that when the markets are down, how many people are cheering and saying, go, go, go lower. That's the mentality that you should want. If that sounds completely alien to you, I get it. But trust me when I say, it's a much calmer way of being, that you want lower prices. I want you to regret not buying something because it was lower, and as it goes higher, have to sit there and say, wait a second, it's still a good value. I should still buy more of it. So guys, here's how I'm navigating all this information I've given you. No matter what the Fed does, no matter what companies do in their earnings, I'm going to do the exact same thing every single week. If I find good value in a company, I'm going to start a position or add to a position. I'm going to expect the stock to go down because it's impossible to buy at the bottom. And I'm going to make sure I understand what drives a company's value. So if the stock goes down in the future, I can buy more of it. I'm not trying to time the market. That's an absolute fool's errand right there. Don't even think about doing it. Just because the stock market to GDP ratio is overpriced doesn't mean I'm avoiding buying individual stocks. I can still find value everywhere. So don't forget to check back in the channel this week. We're going to have our earnings reports and we're going to have our Fed decision reports. And if you want to see the 30 companies that I want to own forever, watch this next video.